Stop scrolling. Right now. Because while you were watching CNBC tell you the silver rally was exhausted, while the same anchors who called January's $1 to $21 print a bubble were grinning Monday at $73, saying the move was rolling over, silver did something nobody on your TV warned you about. It punched through $80 an ounce, and it didn't crawl there. It ripped there. 3 trading days. 73 to 80. A 9% move in a metal these so-called experts swore was finished. If you're holding silver in a safe right now, lean in. If you're stacking junk silver, rounds, eagles, anything physical, this video is for you. Because what happened today, Thursday, May 7th, 2026, is not a one-day wonder. It's the warm-up act. And the people on the wrong side of this trade, the bullion banks in Manhattan, the paper shorts on the COMEX, they are sweating through their suits tonight. Stick with me for the next 10 minutes. I'm going to show you the 3 exact triggers that just lit this fuse. The one number on the COMEX nobody on financial TV will say out loud. And the level silver hits next that flips this from a rally into a full-blown squeeze. Let's go. Here's the picture they painted you on Monday. Silver was sitting at $73. Oil had spiked overnight on a Strait of Hormuz tanker incident. The dollar caught a stagflation bid. ISM prices paid printed hot. And every talking head with a microphone said the same thing. The silver trade is crowded, take profits, this is your top. I want you to remember those exact words. Because 48 hours later, every single one of them was wrong. Wednesday morning, Axios dropped the report. The White House sent a one-page memorandum to Tehran through Pakistani mediators. The proposal, end the war, reopen the Strait of Hormuz in stages, restart nuclear talks. Iran would accept tougher UN inspections, halt enrichment for 12 to 15 years, possibly ship out its highly enriched uranium. In exchange, the United States lifts sanctions in stages and unfreezes billions in Iranian assets. The market didn't wait for ink on paper. Brent crude collapsed. Down 2% on the day. Down nearly 12% in 3 sessions. And silver? Silver exploded. Up 6% Wednesday. Another 3+% Thursday. Trading Economics has the Thursday close at $80.32 an ounce, up 3.89% on the day, up 8.36% on the month, and here's the number you need to read twice. Up 147% compared to 1 year ago. 1 year, a metal more than doubled. And the people running CNBC are still telling viewers to buy more S&P 500 index funds. Now here's where it gets ugly for the shorts. The gold to silver ratio. Yesterday, 60-65. Today, 59-36. That ratio compressed more than a full point in a single session. Why does that matter? Because when silver outruns gold, the market is no longer pricing fear. It's pricing reflation. It's pricing the return of cheap money. It's pricing a Federal Reserve that's about to be forced into rate cuts whether they like it or not. And the bullion banks know it. Let me break down exactly what just happened, in plain English. 3 triggers fired in 72 hours. Each one alone is bullish. Together, they're nuclear. Trigger 1, the Iran off-ramp. Tehran has not formally signed anything yet. Iran's foreign ministry confirmed it is reviewing the proposal, and a response is expected within days. The deal is not done. But here's the trick. For silver to rip, the deal does not need to close. It just needs to stay credible long enough for crude to stay capped. Every day oil sits below $100 a barrel is another day inflation expectations cool. Another day the Fed loses its excuse to stay frozen. Another day the dollar bleeds. Polymarket as of yesterday still had the implied probability of a final US-Iran nuclear deal by June 30th at only around 37%. So this is not a market pricing certainty. This is a market pricing optionality. An optionality on a $100 oil drop is worth billions. Silver picked up its share of that repricing today. Trigger 2, the Goolsby bombshell. This one is the headline most retail investors completely missed. Wednesday evening, Chicago Fed President Austin Goolsby, historically one of the most dovish voices on the FOMC, went on the record with Bloomberg. His exact warning, inflation has not continued to cool toward the central bank's 2% target, and has instead accelerated since the start of the war with Iran. Read that sentence again. The dove just turned hawk. Why does this matter to silver? Because it confirms the thesis. We are now in a stagflation regime where the Fed cannot cut without reigniting inflation, and cannot hold without breaking growth. The PCE print in March came in at 3.5%. The April 29th FOMC meeting produced an 8-4 split, the most divided Fed vote since 1992. 3 voting members tried to strip rate cut language out of the official statement. They failed. Powell exits the building in days. Kevin Warsh, the incoming chair, has hearings scheduled the week of May 11th. The next chair inherits a Fed where the dollar is weakening. The Eastern physical buyer of silver, China, is hoarding record tonnage, and the entire forward curve is mispriced. In a stagflation, gold rises. But silver rises faster, because silver isn't just monetary, it's industrial. Solar panels, EV batteries, semiconductors, medical equipment, 2 demand engines, 1 shrinking supply pool. Trigger 3, the COMEX time bomb. Now here is the number CNBC will never ever tell you on prime time. Per the CME Group's own daily metal stocks report, registered silver inventory on the COMEX is sitting at approximately 76.88 million ounces. Open interest? 575 million ounces of paper claims. Do that math with me. That's a coverage ratio of just 13.4%. Below the 15% stress threshold for 6 straight months and counting. 6 straight months. For every single ounce of physical silver immediately available to satisfy delivery, there are more than 7 ounces of paper claims. And that's the average. The Silver Institute's World Silver Survey, published April 15th, projects a 6th consecutive annual supply deficit, 46.3 million ounces in 2026 alone. Since 2021, 762 million ounces have been drawn down from above-ground stocks. That's almost a full year of global mine output. Gone. Now look at what happened in January. In a single week, 33.45 million ounces of silver were physically withdrawn from COMEX registered inventory. 26% of the entire deliverable pool vanished in 7 days. The pool was never refilled. Not in February, not in March, not in April. The May delivery cycle is rolling right now. This is what the technical analyst Michael Oliver of Momentum Structural Analysis is calling, and I'm quoting his on-record description, a violent congestion zone before lightning form repricing. Robert Gottlieb, the former J.P. Morgan Precious Metals Managing Director, told the Jerusalem Post this winter that there is, quote, basically no free-floating silver left. You don't need a finance degree to read those words. Bank of America's 2026 average silver target sits at $86. Citigroup's standing 12-month target is $150. The bull case scenarios on Wall Street desks now reach $200 to $300. Even J.P. Morgan, the same firm fined $920 million by the Department of Justice for spoofing this exact market, projects an $81 average for the year. Reuters analyst poll has been revised upward to $79.50 from $50 as recently as October. That is not a small revision. That is the entire street capitulating. Now, I'm not going to sit here and tell you the move is risk-free. I respect you too much for that. Friday morning, May 8th, U.S. non-farm payrolls hits the tape. A hot number, wages running above 4%, unemployment ticking down, and yields rip higher. The dollar catches a bid. Silver could give back $2 or $3 in a heartbeat. Algorithms front-run this stuff in milliseconds. If Iran formally rejects the proposal, and Tehran has rejected American framework deals before, crude bounces back to 105. The hot trade reverses. Silver gets marked down to 76, maybe 75. That is a possibility. I won't insult your intelligence by hiding it. But, and this is the entire point, that scenario does not change the COMEX coverage ratio. It does not change the supply deficit. It does not change China's strategic accumulation. It does not change the 762 million ounces already gone from above-ground stocks. Those structural realities don't move based on one payroll print. A pullback in this environment is not a top. A pullback is a refill point. I'll give you 3 specific calls. Each one either confirms the thesis or destroys it. 1. Silver closes Friday above 80. If yes, the breakout confirms, and 84 to 86 is the next resistance band. If we close back below 78, the bullion banks bought another week, but the structural setup stays intact. 2. Tehran responds publicly to the U.S. proposal within 10 days. If the response includes specific deal terms, even vague ones, oil stays capped under 100, the dollar breaks 98 on the index, and silver tests 85 by mid-month. 3. The most important one, registered COMEX silver inventory prints below 70 million ounces before Memorial Day weekend, 18 days from now. When that happens, the coverage ratio falls below 12%. At that point, a single institutional buyer with $200 million can stand for delivery and crack the entire pool open. That is not a forecast. That is third-grade arithmetic. When the pool cracks, silver does not move to 150 in a polite, linear way. It gaps, hours, not weeks. If you got value out of this, if you understand why the price you see on Kitco is not the same thing as the metal sitting in your safe, I need 3 things from you right now. First, hit subscribe. Mainstream financial media will never break down the COMEX coverage ratio for you. They can't. Their advertisers won't allow it. Every subscriber on this channel is one more retail stacker waking up before delivery week. We are building the awakened minority. Be part of it. Second, drop a comment. 2 parts. If you've been stacking since silver had a $14 handle, type OG plus your city. Dallas, Phoenix, Atlanta, Detroit, Chicago, Tampa. Wherever you are watching from in America, let the algorithm see how big this so-called fringe really is. Third, give me your Friday close. Above 81 means breakout confirmed, and we are aiming at 85 next week. Below 78 means the banksters bought one more weekend. Drop your number in the comments. Closest call gets a shout out in the next video. And one more thing, if you know one person, just one, who still trusts the COMEX paper price as gospel, share this video with them. Because every retail stacker we wake up before the rules change is one less person caught flat-footed when the music stops. The rules always change. They just never tell you when. I'll see you in the next one. Stay stacking.